Apollo's Torsten Slok going a step further, writing this: the reality is that the US economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. As a result, the Fed will not cut rates this year, and rates are going to stay higher for longer. Torsten, I'm pleased to say, is with us around the table in New York. Torsten, good morning to you.
Good morning.
Okay, big change. Let's talk about why and what underpins it. You've put out 10 reasons in your most recent note. What's the number one reason for you?
I would say the change that we have had since the December FOMC meeting in financial conditions is really dramatic. Think about it, the stock market hitting all-time highs, credit spreads in IG and high yield continuously tightening. January and February saw the biggest credit issuance in the history of going back to January and February. And you also at the same time have IPO activity picking up, M&A activity picking up. So the tailwind that's coming from easy financial conditions is really not surprising that the employment report in January was so strong. It's not surprising that inflation started picking up in January. This is not statistical quirks. This is really a true tailwind coming from easy financial conditions.
So the obvious follow-up question to this then is that if we begin to believe you, does it make rate cuts more likely again?
Well, the issue is, of course, that we need then financial conditions to begin to tighten. And given that's not happening every day, including today, you're seeing more and more signs of easing. And on top of that, also, as a second issue is you're still seeing short-term inflation expectations in break-evens. 1- and 2-year break-evens continue to march higher and higher. How can the Fed cut when inflation expectations are continuing to march higher? It really is a major challenge for the Fed here, where you both have a tailwind as a result of their own actions, but also with the market now saying that inflation expectations are continuously drifting higher.
Do you think this means, given the fact that you are seeing 2-year inflation expectations surge to such a degree, that this means that the Fed's rate policy right now is not restrictive and that is actually not causing any kind of disinflationary impulse?
Well, that opens up the very important debate about our star and where are we relative to the long-run rate. So if we in the long run have to have the Fed funds rate at 2.5, we are absolutely restrictive. But what's most important about this discussion is that the transmission mechanism of monetary policy is hitting very unevenly. It's particularly hitting companies with high leverage. It's hitting households with a lot of leverage. So that's why those entities in the private sector, households, firms, even some regional banks that have a lot of leverage, that are very vulnerable to interest rates staying high, they are certainly seeing the negative impact. But the rest at the macro level, you see this in the employment report, you see this in jobless claims across the board. The tailwind from financial conditions easing so much just continues to be really strong.
You had a chart over the weekend that I thought was really fascinating about why this economy has been so rate insensitive, in particular U.S. companies, large caps, saying that the larger companies generally have fixed rate debt, they termed out their debt, and this is the key reason why Fed hikes are having a more limited impact on the economy. They account for a greater amount of the hiring. If that's the case, could you see a scenario where even if the Fed keeps rates at 5.5%, you don't see equity markets go down? They keep rallying, at least when it comes to large caps.
Exactly, because the equity market is dominated by large firms. And exactly as you're saying, Lisa, we have a situation where, as you know, 90% of household debt is fixed rate. And when it comes to corporates, it's slightly more complicated. But you generally have, for S&P 500 companies, they are generally fixed rate. And you have Russell 2000 companies are generally floating rate. So that does mean that there are companies, in particular those with a lot of leverage, those with low coverage ratios, low with relatively weak cash flows. For example, venture capital, tech, growth, in particular venture capital, where you by definition buy companies that have no earnings. Of course, they're going to struggle if the cost of capital stays high. So yes, the transmission mechanism is working as the textbook would have predicted. It's just only working on a certain segment, namely those firms and those entities that have high levels of debt.
Let's go back 12 months. Scene. We're sitting around a table. It's a morning like this one. I get something in my inbox. It's an email from you, and the title of it reads as the following: From no landing to hard landing. The hard landing call from a year ago from you. What happened, and why is this economy turning out to be so difficult to read? Why do we seem to flip from one narrative to the other, back and forth, month after month?
Yeah, no, obviously we went into last year, everyone expecting a recession. We went into this year, everyone expecting 6-7 cuts. And of course, the economy just continues to turn out to be stronger. I think that there's a number of things, namely that when we had the situation in March in the banking sector, it was rescued by the Fed much faster than really anyone expected. And that meant that the impact on the economy turned out to be smaller. Normally, a crisis in the banking sector does mean a crisis in the economy. But given that that this was done in a way where the Fed managed to keep this relatively contained. It turned out to be more light. And at the same time, the AI story rolling over us over the last several quarters and still today, continuously giving a huge tailwind. All this just argues today for the Fed looking at that and saying, well, AI and higher productivity, if we do get it, it's going to mean less inflation. And on top of that, we will ultimately, of course, have still strong growth coming, supporting us.
Let's get to that last point. I think it's important because a year ago, the AI story felt more like a market story than it did an economic one. How quickly has it become an economic story?
Yeah, well, so far the gains, we are seeing some signs of productivity growing, but of course all the gains and all the story really is mainly in financial markets. So that's why the wealth effect, in particular on households and retail, who are holding a lot, of course, of Magnificent Seven stocks, they have, of course, been quite significant. So you are seeing especially the wealth effect and, of course, financial conditions being generally easy has been very helpful for GDP growth, not only for consumption, but also for CapEx. So the AI story has certainly come in and taken and sucked a lot of oxygen out of the room in terms of all the other things that were going on. And this continues to be still a very important tailwind to everything that's going on.
How long can we keep this divergence going? Or where the large caps continue to do just fine, and then you have the small caps that are getting blown out of the water, that are going bankrupt, that are really struggling. At what point does that sort of become untenable and there has to be a resolution?
Yeah, no, this is really, really important because you're seeing the same thing for consumers. For households, of course, households who own assets, households who own fixed income, they see more cash flows, they see assets going up, whereas households who have more debt, households who don't own fixed income, of course, are more challenged in this environment with the interest rates staying higher for longer. So it's both when it comes to the household sector and also to firms, that those who are more vulnerable to interest rates staying higher for longer. This will continue. And again, this particular hits growth, tech, venture capital firms, some parts of healthcare, some firms that have a lot of debt, a low coverage ratio, and essentially no earnings. They are, of course, going to be challenged now that interest rates will be staying higher for longer.
Torsten, got to finish with this. So new base case, facts have changed, your views changed. Base case now is no cuts this year in 2024. How many January-like data points do I need to see before I get a new email that says something like there's another rate hike coming?
So this is a really important debate at the moment because this is certainly the pain trade. No one is prepared for more rate hikes coming. But I would also say, John, in your world, think about it. The tips market is saying that inflation is a problem, but at the same time, SOFR futures are saying, no, rate cuts are coming. That's inconsistent. You can't have that. You both have a lot of rate cuts, and at the same time, tips markets are signaling that the inflation is going to remain a problem. So I would say the next data point obviously is, well, first of all, of course, Jay Powell on Wednesday, then we have on Friday non-farm payrolls, where my Bloomberg screen tells me 200,000 jobs in the month of February. That's not bad. That's not a slowdown. So it really does boil down to that we are simply not slowing down. Where is the slowdown that we all had expected for so long, including myself and the consensus and the Fed? Remember, the Fed last year said we expect a recession in the forecast, and they have taken that out. So I think if we were wrong and waiting for Godot for so long, maybe Godot will not arrive in the next quarter or two either.